You don't think rates are going to be moving for years, maybe even beyond 2023? Are you specifically talking about Canada?
I'm talking about Canada. I'm talking about globally. I mean, look, Canada doesn't operate in some vacuum. I mean, here you have Australia, which is also a commodity country, done a much better job on the vaccines than we have here in Canada, and they're linked to the strongest economy in the world, which is China. And their central bank governor said, chill. We have no plans, notwithstanding the monthly or quarterly gyrations in the data. Given the size of the output gap, we're not going to be moving on rates, beyond 2023. He actually said 2024. I think everybody gets wrapped up on the monthly or quarterly data. Yeah, the Canadian economy and the global economy is doing better with the vaccine rollouts and all the optimism. And of course, Canada got lucked out by importing this positive terms of trade shock from the commodity side. And we're going to benefit from the U.S. fiscal stimulus, which is really quite transitory when you think about it. But look at the state of the economy as we know it today. We have an unemployment rate of 9.5%. I mean, before the pandemic, it was just over 5.5%. We have an unemployment rate level in this country that's higher than it was at the peak of the last two recessions, including the great financial crisis. So we still have a very deep, I would say, deflationary hole in the labor market. And you can have all the commodity strength in the world. If you don't have strength in the labor market, you're not going to get any inflationary impulse. And that's the story.
Okay, so let's underline what you're saying here, because it is at odds with what the market is currently pricing in terms of rate expectations for Canada and even rate expectations in the United States. You're saying that the market is likely offside on how early they think those rate hikes are going to be. And if I'm hearing you correctly, you think it's because the recovery is going to take a lot longer and inflation is not going to be something that forces the hand of central bankers.
Well, look, the market has already shown its hand, and if I always agreed with the market, I don't think I would have had a career. So the answer is yes. I think that I am on the other side of the trade when it comes to what the markets have priced in. There's no doubt that we're going to have a couple of quarters of ripping growth in the United States. I mean, that's a no-brainer, and everybody knows that. This is unprecedented fiscal stimulus, but this isn't FDR, New Deal stimulus in the 30s that lasted for years. This isn't the Donald Trump or George W. Bush multi-year tax cuts. This is not the Barack Obama $800 billion of infrastructure over a 10-year span that he unveiled in 2009. I'm quite amazed at what the consensus is looking at here. All this stimulus is going to get us 2 quarters of growth. Now, that's it. It's all transitory. All what you're seeing out of the Biden team is all very short term. It's going to give us a massive boom in the next couple of quarters. But as a central banker, when you have a big picture and you're looking at it in the future, understanding that what you do today operates into the economy with lags, you're going to operate policy based on a couple of quarters of what's really brief, albeit incredible stimulus. I think that the story for 2022, if I'm a central banker, and I know nobody's got this in their numbers, everybody thinks that we're going to have the roaring 20s. I'm calling it the boring 20s. 2022, we're going to have a massive fiscal withdrawal in the United States that's going to come home to roost in Canada. This is all, like I said, this is all very transitory. Central bankers cannot afford to be operating policy based on transitory strength in the economy that's going to fall off next year. The consensus also believes that the economy is going to come back with the snap of a finger, and I think it's going to be a lot more staggered than that. And remember that Canada in particular, we are a play on global growth. And not every country is coming out of this at the same time. It could take the whole world to come out of this pandemic. It could take 5 years as we're sort of just focusing on what's happening domestically. So I just think there's a lot of, I would say, faulty assumptions being priced in right now by the consensus, and I would say by the markets as well.
All right, let's take that argument by the hand and walk it over to the stock market, because the market has been thinking that we are going to get growth. And if we are going to get growth, I no longer need to pay exorbitant valuations for so-called growth stocks. I can now, start to traffic in value stocks. And so the debate is that outperformance in value going to be sustainable? If I'm to follow your line of thinking, this outperformance by value is just temporary. And if growth is not going to be sustainable at these levels or is going to fall short after a couple of quarters, it means that I shouldn't be abandoning those kind of high growth names anytime soon.
Well, look, let's just go back. You said that the stock market's reacting to growth. When the stock market was rallying post March 23rd, into April, into May, into June, when we still thought this might be the bubonic plague, the market was rallying off of all the stimulus. And so it's not always the case as to, what the reasons are for what the markets are doing. For the past year, a lot of it was liquidity and, of course, the rampant fiscal stimulus, which is ongoing. I think that, look, there's lots of reasons why the value trade has taken over. It wasn't just valuations. It's that there is, at least for a couple of quarters, some visibility in some of these COVID-centric names. I would say that a couple of things. First is that, we talk about value and growth as if they're homogeneous entities. They're not. There's parts of the value proposition I wouldn't want to touch. I don't want to touch single idea sectors like airlines or like hotels or like restaurants. But if I want to play the recovery, I'd rather do it in a diversified way. And that's why I've been bullish on the financials. That's a diversified way to play any sort of recovery. The energy story has never been really about what was going to happen with COVID. It was when the Saudis stepped in, when the price was already going up and cutting production. So we're in a new range on the oil price. And actually, the energy stocks probably have 20% upside just to catch up to the underlying commodity. So there are still some areas of value that I like. I think that the growth names, the mega cap tech names, got overvalued. There's some that still have utility-like characteristics that will continue to have strong earnings projections that I think are going to continue to be attractive. But I don't look at value against growth, growth against value. Pick your sectors that make sense and pick your regions right now. I'm looking around the world and I see what is truly GARP right now. And I'll tell you, the Canadian market is not GARP. The U.S. market is the most expensive in the world.
Growth at any price.
I'd say UK, Japan,
or growth
and
at
Germany
a reasonable
look very
price. I just
attractive
want
right
to
now.
flesh that out.
Sorry?
Oh, I was just, if you're not familiar with GARP, just for our viewers, growth at a reasonable price.
Growth at a reasonable price. I'm assuming that every portfolio manager and an investor in the world is watching the show. So I'm sorry for the acronym, but it's basically paying a valuation for the longer term growth rate and earnings. And so what I'm saying is that there are some sectors, and I mentioned energy and financials, have been the two that I've actually liked, and this is from the cautious so-called perma-bear. But I would say right now the UK stock market looks very attractive. Many parts of Asia, and I would include Japan, look very good to me right now. And also in Europe, the German market, the DAX is looking very attractive on that basis.
David, we're almost out of time, but based on everything you're saying, I have to ask about something else that we're addressing, which is the housing market here. And I am curious to know, against your thesis on where we go from here, what do you think is the outlook for the housing market in this country?
Well, I think that it's in a, it's in a huge bubble, and it might be even a bigger bubble. This is where I might disagree with Tef Macklem. This might be one of the biggest bubbles of all time. Of course, it's being predicated on where mortgage rates are. But we have a situation where, home prices are up 18% year over year with practically no wage growth. So, when you mean revert series and you mean revert home prices to income, it looks like a dot-com stock in 2000, 2001. So I'm pretty wary about certainly about the valuations in residential real estate. Would I be going out and buying a home today as an investment in Canada or in the GTA? Absolutely not. I would just assume going to the stock market.